So we still have a few customers joining, so we're going to give it a couple of seconds, if that's all right.
Yeah, no problem.
Right, I think we're good to start. So welcome everyone to today's webinar on market update for insurance for housing sector. Let me just share my screen. We will go through introduction and then we will run the session. So I'm Maria Hadra. I'm one of the buyers at YPO and I will be your host today. Before we get started, I would like to remind our customers that you have joined in a listening mode only. So please use the message facility to raise any questions, and we will answer those questions at the end of the session. So our today's guest is Gary Newlin, Managing Director at JM Glenning Community and Risk Solution Limited. Morning, Gary.
Morning, Maria.
So Gary is both Chartered Institute of Insurance and Institute of the Risk Management certified. He has over 20 years insurance experience, and for the last 10 years, he worked with registered social housing providers. Gary led the National Social Housing Sales and Account Management at Zurich Municipal before leaving in July 2022 to build his own commercial insurance business in conjunction with JM Glenning. So YPO worked with Gary in the last couple of years, and Gary's professional advice and market knowledge actually supported establishment of YPO Insurance for Housing Solution, DPS. So now we will go to the main session. So I will just switch the slides. Just bear with me for a second. Okay. So I will stop sharing my screen and let me upload our presentation. Right, can you see my screen, please?
Yeah, I can see that, Maria. Thank you.
Just a second, let me just start presenting. I just got some apologies, I'm just trying to start. No, I do have an issue. I'm really sorry, I'm just struggling.
No worries, Maria. We've got some time to save back anyway, because I had an introduction plan, but you've done a much better job than I would have. So thank you for that.
Not a problem. Let me just try once again. Right, I think we're now good to start. Yeah, it's working now. Okay.
Thank you. Okay, so as Maria said, up until recently, I worked for a large direct insurer and had a national team that specialised in working with social housing providers, care providers, and non-profit organisations. So that was my more recent career, but I've had 20 years insurance experience despite my youthful looks. But particularly, I loved my time supporting social housing, care providers and non-profits, and really feel that the vital services that they provide for our communities and our country were something to be proud of, and me being able to support and my team being able to support them in a small way by making sure they had a great insurance program in place that responded in the way they needed it to in the worst case scenario. It made me feel really proud to be connected with the sector. So for the last 11 months, I've been building JM Glendinning Community Risk Solutions, which is a brand new business division within the JMG group. And that's purposefully looking to focus on the type of organisations that I've been used to working with. If we can move on to the next slide, please, Maria. So my colleague John Hawkins is unable to join me today. He said that he had a prior commitment, but it just sounded like a convenient excuse, if I'm honest. But John is our group broking director, and has a wealth of experience across commercial insurance. He's worked previously for brokers such as Aon and the Bartlett Group, and has a wealth of experience of placing all classes of insurance for domestic risk and international risks, and is someone that I've worked extremely closely with since joining JMG. When preparing for this session, I thought, even though John wasn't able to join me, I thought it was vital that he had some input on this. And I remember vividly many years ago speaking to a finance director from within the social housing sector who said that as a sector, we're really good at working in collaboration and understanding our own risks. But what we need to be better at is looking externally and learning from other sectors so that we can be aware and be informed of what the potential emerging risks would be. So I think it was really important that we brought that wider commercial perspective to this presentation for the benefit of YPO's customers. Next slide, please, Maria. Thank you. So more so than ever, registered providers need to devise a clear procurement strategy with regards to insurance. There have been some great examples and some terrible examples of procurement exercises that I've been involved in over the years. And the session today aims to stimulate some thoughts and ideas about how risk managers and procurement professionals can work together to get better outcomes for their organisations and their residents. And I feel that if that is more conducive to getting good competition and a good outcome, then surely that's better for all our communities and the residents, because they're going to be able to get better services and the organisation is going to obtain better protection. So we're going to move on quickly and to who JM Glendinning are. So if you'll humour me for a few minutes, I think it's really important to introduce who JM Glendinning are and why we feel we're qualified to discuss this with you. If we'd be able to move on to the next slide, please, Maria, that'd be great. Thank you. So it's probably fair to say that the group were relatively unknown outside of insurance circles until the last few years, and certainly didn't have a presence within the public and social housing sector. So that's something hopefully I'm looking to address with my new business over the next few years. But there's a few headlines there, just to give you a flavour of the credentials and the standing that we have within the UK. So we're now a top 30 broker, and we've been growing rapidly over the last few years, both organically and through acquisition of regional independent brokerages. So my decision to join JMG was based on a number of things, but namely the integrity and calibre of the people that I met within my early discussions made me know that they would be the right partner to build a business that could offer better choice and better outcomes for the social housing sector and those involved in care. So if we move on, Maria, I won't spend too much time on that because the purpose of this webinar is hopefully to be informative, cover good ground and get onto Q&A to see whether anyone has any questions for me. So I've picked maybe an unusual photo there for an insurance discussion, but I felt that if we explain the insurance market in simple terms, it really helps people understand it better and understand what they're procuring. So the picture there is from Billingsgate Fish Market, and this is to try and help illustrate a point. Those of you that are familiar or have seen pictures or videos of Billingsgate Fish Market will see that it's a thriving marketplace where buyers, consumers and producers all meet to trade. And I think the insurance market is no different, really. You have to have consumers to make sure, and those consumers make sure that they source quality produce at a fair price. The producers need to offer a suitable products that are fit for purpose and are sustainable. And the brokers and intermediaries need to make sure that both parties get a good outcome. consistently, I think, is important as well. Both parties need to get a good outcome consistently. Otherwise, the producers don't want to distribute via them, and the consumers won't want to purchase via them. So the supply and demand, as like any market, it dictates price and dictates availability. But within insurance, that's related to the financial capacity that insurers are willing to offer for given risks. And the demand is driven by numerous factors. But some of them can include regulatory necessity to purchase insurance, looking to obtain balance sheet protection, and transfer risks as part of a wider risk strategy. And I think I think back to the Institute of Risk Management studies that Maria referenced, and truthfully, I didn't know that she was going to include that in the introduction, but I'm glad she did, because it's created a perfect segue for me to explain that. When I've talked with clients in the past, I find it's always really useful to understand insurance as part of a wider risk strategy, a wider risk discussion. And there was a principle within the study text around the 4 T's. So when you're looking at risk, it's really useful to understand whether you can treat, terminate, or tolerate risk. And if all those 3 don't fall within your appetite, then you look at transferring that risk to a willing insurer in return for a premium. So when you look at insurance in that respect, you do have to look wider as to how it's going to be best utilised and at what point you decide to transfer that risk in return for purchasing and paying a premium. I think it's also fair to say that the UK insurance market is mature and admired by the world, and it's made up of organisations large and small. So just like that fish market analogy, there are insurance equivalents of the large supermarkets, the wholesalers, the boutiques, and the high street vendors, which all offer some potential for new markets, but I genuinely feel might have been overlooked or untapped and could be of benefit to social housing in future. If we could move on one more, Maria, thank you. I'm definitely going to owe you a coffee after this for helping me navigate these slides. So if you're sitting listening to this as a procurement professional, it's probably important to understand how the insurance market is constructed and some of the main entities that would partake in that. If you're a risk professional, you might not fully understand the nuances of the insurance market. So I think giving a wider perspective of all of this helps you become a more informed buyer, a more informed commissioner, and as a result, get a better outcome. So in terms of brokers, there's a whole host of different brokers. There's multinational brokers, there's national and regional brokers, and there's even independent agents that trade via networks. And those networks will help smaller outfits benefit from the support of the networks. You can even get wholesale brokers who offer access to their markets to other brokers. And all of these can play a part within that ability to obtain equitable cover and different choice. MGAs, I think, are an area that are largely untapped for social housing. And an MGA stands for a managing general agent. So these act as intermediaries between insurers and brokers, and they can represent one or a number of insurers and will often have some specialist expertise and maybe even delegated authority to write cover up to certain limits for pre-agreed types of risks. So within the JMG group, we actually have Focus MGA. It's a business within, like I say, our group, and it specialises in construction and trade risks and insurance covers and activities associated with those type of activities. They have a delegated authority with firms such as Zurich, NIG, CNA, and Tokyo Marine, for example. And the advantages to an insurer of transacting via an MGA can include low fixed costs, that access to speciality expertise, and they can provide operational services on behalf of the insurer. So when I've spoken to my counterpart at Focus MGA, who was also an ex-colleague at our previous employer, his words, and I think it summed up perfectly, is if our service isn't as quick, it is not quicker and not more efficient than some of the big insurers, then there's no purpose for us to be in existence. And like I say, I think MGs have been largely untapped as a source of choice for both the public sector and social housing providers. So if we look to the right side of this slide here, there's a few different types of organisations that it's worth us covering. So reinsurers offer balance sheet protection to other insurers and allow insurers to transfer layers of portfolio or layers of risk off of their balance sheet onto someone else's. So reinsurance rates have spiked significantly over recent years due to the scale of losses and claims they have experienced. And this is one part of why I think social housing particularly have seen a hardening market and increased rates over the coming year. So insurers and direct writers will either work directly to client or provide terms via a broker. And like I said already, we'll sometimes consider using an MGA for people to access their products. If we move on to the next slide, Maria, thank you. So quite a busy slide here, but I'm sure YPA will provide a copy of these afterwards to anyone that's interested. So whenever you're looking at running a procurement exercise or purchasing, it's really important to understand at what point within the insurance cycle you are, because you might have had people reference soft markets and hard markets, but what does that actually mean to you? So I think it's worth us spending some time on this, because depending on where you are within this cycle will depend on the availability of the products you might be able to get, the capacity that might be interested in your risks, and also the breadth and scope of cover that might be available. So the insurance market, like all markets, is constantly evolving, but it follows a general cycle of hard and soft conditions, which essentially reflect the economics of supply and demand. Where insurers are chasing premium volume, their appetite for risk supply is plentiful. And as a result, premiums fall and policy wordings become wider with reduced levels of policy excesses. This positivity typically leads to commercial decisions, overriding underwriting discipline and softening of approach when it comes to being, with the outcome being policyholders get more cover for lower premiums. A deterioration in the loss ratios, which then reduce profitability and ultimately result in the insurers making a loss. Where insurers are loss-making, which can be caused not only by underwriting losses, but as we have recently witnessed, also the impact of poor investment returns, claims inflation, changes in legislation such as the Ogden discount rate around injury claims, and Solvency II, which is requirements about how much capital insurers will need to keep in reserve to pay your claims. If we add into that extreme weather, such as the floods and storms that have been prevalent not only in the UK, but globally, the cost of reinsurance is definitely going to be affected. And to compound that, rising interest rates. Action is always required and a change of strategy is undertaken. So the insurer response typically follows a move to a quality approach, which is delivered by cleansing and correcting their book of poorly performing businesses. So looking to fix poor performing portfolios or take corrective action on wholesale on portfolios that they have. It might mean limiting their exposure to challenging sectors or even exiting the market altogether. The outcome of this hardening approach results in restricted appetite, and as a consequence, cover is restricted, policy limits reduce, and premiums rise accordingly. So this process is demonstrated in the insurance market cycle clock, as shown on this slide, and links back to that discussion we were having about supply and demand. Whilst insurer appetite this time remains limited for heavy risks, particularly in challenging sectors, the insurance market as a whole is currently viewed as being past the peak of the hard market, or to be plateauing with green shoots of recovery that are clearly visible, having undergone a period of intense correction after more than a decade of benign trading conditions, which is the longest on record. I would say that is more akin to the commercial insurance market than social housing and public sector, because whilst there might be green shoots in other trades in terms of softening of market, I think there's not evidence of that just yet in the insurance sector for social housing and local authorities and non-profits. So the hardening of insurance market was prompted initially by Grenfell and the subsequent correction of the professional indemnity market, specifically around design and construction PI, before spreading to property insurance, particularly any risks, residential or commercial, that were exposed or had presence of combustible insulation. And it's particularly residential risks that have been hit heavily. Where previously insurers had the presence of insulation, and that was enough in terms of data declaration, there's far greater scrutiny now applied, and they want to know a lot more information about the construction type, methodology of the properties that you own. Obviously, the bigger you are and the greater the portfolio of assets you have, the more complicated this is to satisfy that disclosure. So where policyholders are unable to confirm the nature of the insulation used in their properties, appetite is now very limited. And that's not just for social housing, that's for private residential portfolios as well. If you couple that with the increasing focus on energy efficiency and stringent targets that now need to be met, and adoption of modern methods of construction, insurers are no doubtly going to remain cautious. The efficiency secured in both construction and energy costs through this innovation can be outweighed by the cost of insuring these properties. As alluded to already, where insurers had previously chased business and made positive assumptions or relaxed the underwriting disciplines, an increasingly considered approach is now taken to risk selection, with insurers restricting their appetite and reducing the capacity they were prepared to deploy. Obviously, COVID played a part within a subsequent global economic slowdown, the collapse of a number of PLCs such as Carillion, Patisserie Valerie, had the knock-on impact across the wider supply chain, causing further insolvencies, particularly at an SME level. And this has contributed to concerns around profitability for all insurers. Further exacerbating this, from a placement risk perspective, has been the withdrawal of a number of insurers from the regional and London markets since 2015, such as Tokyo Marine Kiln, Aspen Risk Management, MS Amlin, and Neon Syndicate. And that all compressed further the amount of capacity available in an already challenging market. The inevitable consequence of this reduction in both appetite and capacity has resulted in significant spikes in premium, which drives risk to market as brokers seek to contain costs and mitigate increases wherever possible, thereby increasing demand of a time of unprecedented restrictions in capacity. So it's a catch-22 really, is restrictions in choice, but a need to continually test value for money. So I think this is really why it's important to make sure that you're informed and educated about what it is that you're looking to procure, to make sure that you get a long-term outcome that's going to deliver great value for your business. So the emphasis is really on working strategically to successfully trade, starting with a clear match between your risk activities and the underwriting appetite. So we're going to move on to the next part of this webinar, which is around how you achieve maximum interest from bidders. Because truth be told, I've been party to decisions of qualifying opportunities and deciding not to progress. And obviously, when you're looking at opportunities and tenders, a significant amount of resource and time will go into preparing and understanding them. So the last thing you'd want to do is invest months of work only to withdraw at the very last moment. So the smart logic in how you work is to get to that conclusion very, very quickly as to whether you want to participate or not, so that you're not using underwriters' time, your own internal resource, to prepare a bid that you're not eventually going to submit. So I think there's a number of things that people can consider as they look to launch their tender that would help engage bidders and create maximum interest, which is surely what you want from a tender exercise. If we could move on, Maria, that'd be great. Thank you. So I think working strategically, Working strategically when it comes to these type of exercises is absolutely key. The key to securing best response from insurers is to provide them with confidence in a culture of risk ownership, that the appetite remains restricted for risk with a very transactional approach. So those organizations that don't demonstrate that they're really looking to work in collaboration and partnership with the brokers and the insurers are going to receive limited interest from the market. You have to make sure that you demonstrate a positive approach to managing these risks. Underwriters respond best when they've got clarity and certainty. So positive results can be secured where a direct or tripartite engagement involving brokers, clients, and underwriters can be facilitated, and pre-cover and pre-quote surveys can be undertaken. So that thereby removes uncertainties or the risk of misunderstanding of the exposures presented. Early engagement with quality submission is essential to attract the attention of an underwriter who will want clarity and thorough understanding of the occupancy of your buildings, the type of tenures and residents that you might look after, risk management controls and protections that you've put in place, full and robust construction details, explanation of any corrective measures that you have taken to prevent reoccurrence or occurrence of claims, along with details of investments that you've made that are projected to have been made, and an explanation about how that will improve the risk. I think from a procurement perspective, it's also useful with these market conditions not to be overly prescriptive in your requirements. Engage with providers and ask them to demonstrate their knowledge of your risk and their expertise. How can they add value in terms of your risk and insurance program? And do they really understand what you require as a business? For you to know whether they understand your risks, you need to have some comprehension of what your key risks are. Procurement need to work hand in hand with eventual contract owners to make sure they understand what is needed. You also need to discuss at an exec level what the corporate risk appetite is or tolerance to loss. I remember seeing many organisations' strategic risk maps in years gone by state a tolerance for 1 million of fraud, and then have a couple of £1,000 of excess within their insurance program. To me, that screamed out a disconnect in terms of that risk strategy. Although I do accept there might have been lender requirements on the stock that necessitated lower excesses or other reasons as to why that kept low. I mentioned about procurement working hand in hand with the eventual contract owners, but consideration should be made to who else within your business should be involved. Is there a director of care or assets, or is there a fleet manager that's got a vested interest in the outcome? The best processes I've been involved in offered access to these people and have those people involved in the ultimate decision as well. That might be through Meet the Buyers Day, that might be through opportunities for one-to-one or group exploration meetings, but the bidders are going to be able to give you their best response when they really understand your capability and how they can add value. Once this has all been scoped out, you need to create a presentation that clearly articulates your organisation and your knowledge of the risks and the overall strategy in place. Why are you better managed, or why are you a better managed organisation or a better risk than your peers? Capturing interest is critical, as insurers and brokers do not have the resource to respond to all be involved in every single case. And the nature of the months that you typically renew mean there's a massive bottleneck in terms of when those tenders start and when the evaluation takes place. And when resource is finite, your number one job is to make sure that if they were going to select a tender to invest time and effort on, it's going to be yours. I'm sure you've heard it many times, but data is absolutely key. Underwriters need it to be clear and easy to understand, as their pricing and decisions and their decision to offer terms will be based on their confidence in understanding your risk. Bidders will take time and effort to participate. Take a long-term view to all of the relationships, even those that are unsuccessful, as you never know when you might need to engage with them again. Suppliers have a long memory, and an honest and transparent communication is appreciated. So Maria kindly alluded to the amount of time I've been working with social housing providers. It's upwards of 10 years. And I can honestly say there are still individuals and people in the sector that I dealt with nearly 12 years ago. Some of those are in the same role. Some of those are in the same role, but at different organisations. Some of those have climbed the ranks and are now main decision makers. And that's because social housing and public sector is nuanced. You need to have that expertise to be effective. But from a supplier's perspective, it's equally nuanced and equally specialised. Within the JMG group, there's many accomplished managing directors that have built commercial brokers businesses over 20 years. And when I've met some of these, it was a bit daunting, if I'm honest. But the reality was none of them had a clue around OJU or procurement. And whilst they had grown the business from scratch, they wouldn't have been able to navigate how to access these bids and tenders. So, like I say, just make sure that you treat your suppliers with the respect that you would expect to be treated, because that same person in 5 years' time could be making the decision as to whether they want to participate in your tender or not. If we can move on to the next slide, please, Maria. Thank you. So whilst we've talked about best practice, I'm sure all of that, there might have been some useful points there, but it's fairly common sense. And that should be the point when it comes to procurement. And it's certainly the point when it comes to risk and insurance. But let's talk a little bit about some of the common pitfalls that commissioning organisations have made. So if we move on one slide, please, Maria. So it would be really easy for me to sit here and say that the opposite of what I've just said is true around the pitfalls. So the opposite of good engagement is not going to be conducive to a good outcome. It's not going to mean the tender process is ran effectively. But I didn't think that would offer any real insight. So I thought it might be worth sharing a few real examples of, quite frankly, awful tenders I've been involved in, and how it appears from a supplier's perspective that value's not been achieved. Everyone loves a case study as well. So I thought that might be of interest to those that had registered for this webinar. So for obvious reasons, identity and individuals will be protected. But for those that have met me before, I don't pull any punches in terms of saying what I think. So I'm going to refer to these as horror tender scenario 1, 2, and 3. So the first horror tender scenario I remember being involved in had a procurement individual who had already committed to a saving of 20% on insurance costs to the exec, purely based on his belief in his abilities to negotiate and beat down suppliers, it appeared. He'd moved from a massive social housing provider where he felt looking at the premiums that were being paid at that provider was all he needed to know to negotiate a 20% reduction and commit his name to that when he moved to his new role in his new organisation. When we met and I asked what constituted a good outcome, pretty much word for word, well, I worked for XYZ registered provider and our insurance spend was X amount of millions. And I think that we can get near to that spend where I am now. The fact that I pointed out that they'd have a completely different stock profile, and I knew they had a different excess structure and a different geographic spread, and the claims history wasn't going to be identical, was completely lost on him. It wasn't even that he didn't understand it, he just wasn't interested. When asked about quality, his criteria was purely about all suppliers meeting a minimum standard, and then everything else was weighted on price. All bids went back to this individual with very little evidence of a review panel. So in reality is that most suppliers will score similarly on quality and are pretty adept at writing bids these days. So how do you really differentiate quality? This individual wasn't interested in any aspect of that whatsoever. And it was clear to me that there was either a foregone conclusion in terms of the tender, or quite simply, he was looking to make his name, achieve the biggest cost saving possible, and then move on to the next procurement exercise with little concern as to how the contract actually performed. So that was one in particular that must be about 8 years ago, but I still have nightmares about now. So horror tender scenario number 2. So we'd been informed within conversations that there'd been a claim that hadn't been paid out full, and it wasn't insignificant. A significant loss had occurred, and the settlement check was short by a couple of £1 million to allow full reinstatement. I'd have expected something like this to have a material effect on the outcome of the bid, and it didn't. They reappointed the incumbent supplier that throughout the engagement process they'd been very disparaging about. And this has happened more than once in my career. I absolutely accept that as procurement process, you have to be forward viewing and can't take into account historical issues. But surely a failure such as that, where there's significant cost to the commissioning organisation, must have a bearing. It makes other suppliers feel like, what was the point in terms of taking that time and effort to bid? So I'd really have a think about, coming back to what we've talked about before, what constitutes a good outcome. If actually there's other aspects of that contract that outweigh the fact the claim didn't get paid out in full, then be clear with that around bidders so that they can equally respond to that. Horror tender number 3. There are many more, but I was conscious that we were limited for time, so I've stuck with 3 for the time being. So a large organisation in hard market conditions eliminated a number of credible bidders without giving them the opportunity to quote, as they felt the response on social value was not as comprehensive as other bidders. The bid was lotted as you would expect, but there appeared to be no consideration on proportionality of this section in relation to the number of lots. And it meant that some niche players were interested in certain segments of the insurance portfolio. But in the procurement's haste to make sure that they were working with the right partners, they invoked the elimination part of the process to whittle down bidders way too early in the process. And that, for me, stunted choice and meant that they didn't get a response in terms of priced quotes from what could be some very credible suppliers. If you think back to the fish market analogy, where we were talking about, there's your big supermarkets, your wholesalers, your boutique, artisan producers, and your high street vendors. Some of these will be excellent in the space that they operate in. So make sure your procurement process engages those and makes those feel inclusive. Procurement talk about how they want to embrace SME, but the reality is that there's a number of barriers to entry. So eliminating some of those players before you've even seen the terms and the product that they can offer and access, I think is a massive mistake, particularly with the market conditions as they are. So I thought I'd finish on a final thought before opening up for Q&A. So I've been thinking and speaking with lots of people since my departure over the last 11 months around the market conditions. I've been speaking to potential producers, other insurers. I've been speaking to new and old contacts about the challenges that are being faced by social housing and those with insurance portfolios that have complicated risks, whether that be safeguarding concerns, vulnerable people, whether that be complicated property portfolios or property stock. And I think with the hard market conditions, there's a growing need to be able to stitch together a greater number of complementary and bespoke solutions from potentially a number of different suppliers. So you need to consider ways of how you set up your resource and have the skill set needed to help manage these partners in a way that is conducive to getting an effective ongoing contract that delivers long-term value. So if market conditions and the times mean you need specialists and not jack of all providers, you need to think about how you're set up as an organization to make sure you manage those partners effectively and embrace them. You could find the best person for a particular policy, but like some of those horror stories said, you could exclude them if your process isn't set up correctly. So on to the final slide, which is now an opportunity for Q&A. I've put my contact details on the slide there for anyone wishing to speak specifically or separately around anything discussed, or just generally discuss risk and insurance. So feel free to make a note of those. But Maria, has everyone fallen asleep, or are there any questions from the audience?
No, actually, we have a couple of questions. So let's
Okay.
see what's been asked. So the very first question we have, Gary, what innovation insurance covers for housing associations are planned?
So I think innovation is an interesting phrase. So I've spoken with organisations in the past around innovation, and when you asked them to describe what they meant, their response was simply around being more creative with the deductible program, which for me wasn't real innovation. It's just effective way of understanding how you want to shape your program and at what level you want to transfer risk. So I think there's still a lot of merit in not necessarily chasing new ideas, but revisiting tried and tested ways of managing insurance programs. So I think in terms of innovation, what will be interesting is to see when new choice has been attracted to the sector, what they will bring, because they might have a predetermined idea as to what comes with social housing. I think that's fair to say. Many insurance companies that I'm speaking to, when I've been speaking about social housing, do have an impression of the sector, and that's going to be swayed by media coverage. That's going to be swayed by some of the high profile damp and mold claims. What they might not be privy to is all the good work that's being done and all the investment and how passionately organisations are about looking after their residents and tenants. So I think innovations, I'm all for innovation, but I don't think it should be innovation just for the sake of innovation. I think it's worth looking at things with a fresh perspective, really making sure that your exec team are engaged with insurance because they understand it's an extension of the risk discussions they already have. And that point around the 1 million fraud tolerance on a risk register, and then having like a £2,500 excess on the property stock, is that really an aligned strategy? If not, it requires that conversation, and that simply could unlock new markets. It could unlock cost savings. It could unlock better value within that insurance program and the capability to deal with those claims.
Brilliant, thank you. We have a next question, which I really, really like.
Am I going to like it is important though, Maria.
Yeah,
okay.
And I'm really interested in your answer.
Okay.
So, who is the worst and the best insurer in your opinion?
You can't ask me that.
Well, that's not my question. That's a question.
Yeah, look, my contact details are there specifically if someone would like to ask me that outside. I don't think that's fair. I don't think you can be as generalized as saying some are best, some are worst. All of them will have their moments where they shine in glory, and all of them will have their moments where they'll look at themselves and say, we could have done better. I don't think any insurer knowingly goes out there to provide bad service or restrict cover. It's just the way business is for them. They have to understand if a portfolio is not performing correctly, corrective action needs to be taken place. I think there are some fundamental things that could be learnt by insurers. And my experience now, I deal with a lot more insurers than I've ever dealt with before in the role that I've got now. And I think it's pretty old. I mean, it's not rocket science. And this goes back to that answer around innovation. Like the basics are what people appreciate. Like accurate and timely documents are really, really important. Like clear communication, early engagement about any changes to policy, coverage, or premiums. I think all of those things will be appreciated by commissioners and organisations. I think any organisation that doesn't care about doing that and is more interested in either being involved short term or purely involved for profit, I would not look to trade with. But I've not met anyone that sort of enters from an insurance company, enters with that mindset purposefully. I think obviously because it's a financial protection, you do need to be cautious about making sure the markets and the solvency is correct and adequate. So that's why a lot of the tenders have credence around minimum ratings and credit ratings. There's no point paying a premium to someone that you hope is going to pay out in the event of the claim, and they're unrated, non-domiciled, and they haven't got the money to pay out the claim. So hopefully that answers it, and people don't think I've given a political answer and dodged the question. But
no, that's really good. Thank you. And we have one more question. What policy length would you recommend?
Policy length?
Yeah.
Okay, so I think that, I mean, there's two thoughts here. There's the actual policy term, and then typically there'll be the long-term agreement. And I think two of those can be, should be viewed differently and need to be understood. So I think that in terms of policy period, typically all of your policies will be a year. There might be the odd ones that can be greater than that length, but policies tend to be 12 months, or you might be able to incept it midway through another policy if you're adding it onto a main program and align the renewal dates. So in terms of policy coverage, typically they're going to be 12 months in period. I think in terms of opting for a supplier that's going to work with you longer term, this is where I use the phrase around partner, relationship. It's going to be incredibly hard to develop a strategic partnership that's built on trust and that can add value within 12 months. I think it's impossible. And that's the type of relationship that you would do for your car and home insurance. You just chop and change every year, go and compare the market, whatever. That's not how commercial insurance should work, I think, because once you select someone to work with, if you're taking that approach where it's part of a wider risk strategy, you're going to be making sure that the cover is adequate. You're going to be looking to understand the risks. You're going to be working together on suggestions to improve that risk. And then you're going to want to see the fruits of that improvement. So I think that definitely long-term agreements typically are 3 to 5 years. I think 3 years you start to just get into some momentum with an organization where you've really, if they're a new business to you, you've really understood them, you've really identified some areas that you can offer support. So I would say like minimum in terms of long-term agreement, I'd be looking for 5 years, but I appreciate some people might be looking for that sort of 3+2 option where they can test a provider before committing too long. But yeah, I definitely don't think policy period and the service provision are one and the same, if that makes sense.
To the lower levels seen pre-COVID, and if not, do organizations need to be prepared for discontinuing higher costs?
Maria, could you repeat that one again? Sorry, I don't know whether there's some buffering or something there.
Sorry. Will insurance premiums ever get back to the lower levels seen pre-COVID? And if not, do organizations need to be prepared for discontinuing higher costs?
Yeah, I think that's a given. I don't think there will ever be a return to the soft market conditions that have happened since. And I think there's a number of reasons for that. I think in terms of capacity, a lot of the insurers are aware and have either insured social housing local authorities before and might be cautious about that, doing that again if they've suffered significant losses. And new entrants need time to understand and get that clarity and confidence around the individual organisations that they're looking to put forward terms for. I think what we've talked about is revisiting traditional concepts of how you run an insurance program. And that's around at what level do you transfer? What decisions do you make around self-insurance? How do you get that comfort around whether you are able to treat, terminate, or tolerate that risk before transferring? I remember having a conversation with a treasury director many years ago when we were talking about strategic risk, and one of the things I said should be incorporated within his risk map is around the availability of traditional insurance covers. So many of the sector have got presence of high rise. My caution to him was, what will happen if everyone says we're not insuring properties with green doors now, and 50% of your stock's got green doors? Obviously, I'm sort of being a little bit flippant about the example there, but hoping to illustrate the point. So a real risk to organizations is that insurance at the prices that you used to be able to pay is not going to be available if the coverage is available at all. So what do you do around that? And I think that's where you've got to be a lot more smarter around how you layer, how you utilize specialist suppliers, access new capacity, and come back to that point around stitching together like complementary organizations. So you might need to be prepared to work with one organization that can get you the best of breed and most competitive cover from a cyber perspective. But you might realize that your property stock is so big that it's only going to attract a handful of insurers. So how do you offer ring fence that, offer it out so that insurers can co-insure or have layers or work alongside each other so that your whole portfolio gets the cover it's needed to the defined trigger point that you need that cover for, as outlined by your exec. But managing those relationships needs time, effort, and needs the right skill set. So yeah, I don't think we're going to ever go back to pre-COVID costs, but organizations have the ability within their excess structures and how they devise their programs to look at things more commercially and help control those costs.
One more question, please, if you don't mind. So, Gary, what aspects in partnership are important for insurers?
What aspects in
partnership are important for insurers?
I think it's credibility and trust. Like, trust has to be built. So the nature of the relationship between brokers and insurers has to be built on that. So if a broker is supporting an organization in obtaining best terms, the insurer needs to get that, have comfort that the person supporting the organization has that track record, that knowledge, that expertise that's going to help them as an insurer not put forward unsustainable prices, mean that they suffer significant losses and affects their balance sheet. And I think that's one thing that I'm really looking to do with the conversations I'm having. There's no point attracting new capacity in new markets that are going to dip their foot and think this isn't for us in 12 months time, because all that does is, again, churn capacity. It means that there's now another handful of people that aren't going to be open to supporting social housing. So I think it comes back to that bedrock of really understanding your risk, being very clear and transparent in the communication, and looking to earn that credibility with the insurers, so that if they have capacity for large, complicated, graded buildings, for example, and they've got capability of dealing with residential portfolios, or they deal in care, actually, if you've got appetite to do that and you specialise in that, it's not a massive departure to start considering social housing. And why have they not done that in the past? Is that because the media portrayal of it makes it unattractive, or are there other factors? So honest conversations, get to the crux of what the problem is and see whether that's something that could be overcome.
Absolutely, thank you. So we don't have any more questions, but just for our customer information, I would like to let you know that Gary and James Glendinning is one of our approved providers for social housing solution DPS 1051. So if you will have any questions, you can get in touch with Gary directly, or just message insurance@ypo.co.uk. We can pass your query on to Gary, or we can set up a call and we can help you that way. So thank you so much, Gary, for your time. It was really, really good session. We had a lot of questions. What we will do also, we will share your slides with customers and recording. So for those who couldn't attend the session, they will be able to come back to us with more questions later on.
Brilliant. Thank you very much for that. Appreciate it, Maria. And thank you for everyone that registered and attended. I do appreciate it.
Thank you so much.
Take care. Bye.
Take care. Bye.